On this panel, with my guests who I'll introduce in a second, we're going to talk a little bit further about maybe what that dual captive regime might look like, how it fits in with the GAR, and everything that should be considered, and maybe even some of our wish lists, or if the important people are listening. And we're also going to be talking about PCCs, which we didn't touch on earlier, but obviously a very important and flexible part of the insurance landscape here in Gibraltar. So our four panelists, I think many of them, or all of them, you probably are familiar with. We have Michael Ashton, former senior finance executive at Gibraltar Finance. We have next to me, we have Kathryn Morgan, who's an experienced actuary, former regulator, and a non-executive director today for numerous insurance companies.
Just enough.
We have Graeme Henderson, executive director at Euroguard Insurance Company PCC Limited. And we have Adrien Collovray, head of captive advisory for GB International and Europe at WTW. So we're going to start off with the kind of dual captive regime chat, and in the second half we're going to focus more on PCCs, but everyone is welcome to chuck in and share their 2 cents. So Michael, I think just to start with, and I think you touched on this a little bit earlier, but when did Gibraltar first get into the captive business, and what made it originally an attractive captive proposition for companies?
I mean, maybe first of all, I should just say I had a quick history lesson from Chris Johnson, who's in the audience and has been in Gibraltar for probably getting on for 40 years, Chris, I think. And he just sort of went through. So I think the first captive was in 1967, which was Bass, the brewer, yep. And they set up here, went through various iterations as they moved their business model and became IHG, International Hotels Group, and so they were there in Gibraltar for more than 40 years. And I think a number of other captives came in that intervening period, but I think the key area was probably in the late 90s through till about 2008, 2009, when the captive industry really sort of took off in Gibraltar. But in some ways, I think we've talked about other jurisdictions as well, and some of them have much lower capital requirements. So Gibraltar, by being a Solvency 1 and then a Solvency 2 regime, the captives had much higher capital requirements. So I think what sort of led to is we have a core number of captives who are very large, whereas maybe those minimum capital requirements are not really so important to them. I mean, in the sense that they put the capital in, and they can be some loan backs to parents, but effectively that wasn't a limiting factor for them. Whereas for many jurisdictions, if you've only got a limited amount of capital, then you're going to probably look to Guernsey or the Isle of Man in Europe as a jurisdiction where you'd want to set up. So I think, but the key area I think was around those dates when some very large international clients and PLCs set up their captives in Gibraltar.
So obviously, that major headwind, you sort of kind of, I guess, that golden period of the kind of early 21st century pre-Solvency II. Then Solvency II was that real headwind, obviously a prolonged soft insurance market, the kind of value proposition for captives across Europe, across the EU, not just Gibraltar, definitely went down. It was harder to sell them. We often saw more captives closing down post 2013-14 than we did setting up across all of Europe. And then, of course, we have the Brexit, which is another definite challenge for the Gibraltar insurance market, and particularly captives, because part of that USP went. So before we get into what we're hoping for with what we might see with the dual captive regime, Adrien and Michael, why is there a need? Why is there a demand from industry for amendments and changes to what was the status quo here in Gibraltar for captives?
I think if I kick that off, I think really Gibraltar's got an opportunity to position itself as a differentiated opportunity within the captive marketplace. I mean, we've got a number of non-admitted jurisdictions. We've mentioned them before, the likes of the likes of Bermuda. I'm cutting in and out a little bit. But there's I like to use the analogy, sort of the Daily Mail reader test. Right. Essentially, if the financials of your captive were to get into the Daily Mail, what would be the perception of those readers? Right now, if we were to look at some of the other jurisdictions, I won't mention them necessarily in this context again, there might be, zero tax reference at the bottom. There might be the perception that there's tax havens being involved, etc. Now, I think Gibraltar being much more aligned to the UK. The fact that Gibraltar does have a position on tax differentiates itself from some of the competition that exists. And so where there are a lot of captives, and certainly we've seen in France, for example, you mentioned it earlier, Richard, that there's a lot of captives being formed from companies that didn't previously have captives. There is a lot of interest in the UK as well from companies that want to establish captives, but are a little bit concerned about some of the other domiciles that exist. So Gibraltar has the opportunity to offer an alternative for that, I think.
But what needs to change then to the regime currently to make it attractive? And maybe Michael, you talk to all of industry.
Yeah, I think there's sort of two aspects actually. There's one is that we talked about this acronym, the GAR.
Yes.
And I think you're going to sort of ask about that a little later. But what that did is it gave Gibraltar, as I think I said earlier in when I was chairing the previous session, it gave Gibraltar this sort of unique position in the sense that it has market access, passporting rights into the UK, which no other jurisdiction has. And the UK government said, look, if you want those rights, then you have to align, and we'll come back to that. But if you're not looking for passporting rights into the UK, then Gibraltar is able to have a dual regime. And they've done it already with a funds regime. So there's a dual funds regime, which is outside, as I understand it, outside of the MiFID rules. And so the opportunity, some of the insurance managers, approached the government in probably at the very beginning of 2022, I think it would have been, and said, look, what about setting up a dual captive regime? We've been, we're on the shopping list when we have new captive clients, and we say, look, we put Gibraltar forward, but where Gibraltar fails is one, or doesn't succeed, is one, maybe the capital thing. That's probably not the real critical thing, but it's the operating costs, which are associated with Solvency II. Yeah. And so our operating costs as a jurisdiction are just too high compared to other jurisdictions, and we lose out, as I've been told, consistently we lose out. So the opportunity was, is there an opportunity to set up a dual captive regime which would look at, for example, global property programs where you don't need particular access to the UK, but where you could then approach the regulator and say, can we work together to create something here which will mean that Gibraltar can be competitive in terms of those operating costs and the requirements around that new captive. I think that's really where it's led from the original discussions that when government was approached.
So explain to me, Michael, lay out in layman's terms again, and I'm sure most people will already be familiar with the GAR, but in terms of how it applies to captives, what it means is it simply mean that if you're a captive or an insurance company writing business into the UK, you have to basically follow the solvency regime here is basically the same as the UK solvency regime.
There were really sort of three pillars to that, and it was one that you get your access. So it's the same if you're operating from Gibraltar as an insurance company or intermediary. It's the same as operating from within reason, Bristol, Birmingham, or Edinburgh. But the UK government, in return for that, in the reciprocity, was that it would be regulatory alignment, which I think will be coming up maybe in one of the later sessions. Secondly, the same enforcement proceedings. So we would have similar enforcement proceedings. So it's not, they weren't never looking for, I think, an absolute mirror image, but they were looking for. And then thirdly, there was very strong communication, which I think there was in any event, between the Gibraltar regulator and the PRA and the FCA. So there were the three things that really underpin the GAR. And then it's taken time in terms of a lot of work going on, a lot of, I think, positioning to check that. And as we know, it's sort of been postponed, but the latest position is it will be introduced at some stage next year.
So, and am I right in thinking then that the dual captive regime, if it were to materialise soon, would allow divergence from that as long as you're not writing UK business?
So again, I mean, and I haven't been involved in for the last 6-8 months, but prior to that, we would see the existing captive regime, which would allow passporting, so that would stay the same. But you'd have this second sort of regime, which wouldn't be having passporting rights, but would then have different requirements in terms of the operation and therefore the cost base that those businesses would be incurring on an annual basis.
So it's more like, Adrien, it begins to look more like your other kind of reinsurance captive domicile options.
Yeah, and I suppose that's the challenge. We haven't seen the framework that's going to be put out, right? So we don't know what to expect. But really, I think my concern would be the risk of the GAR, right? Yeah. In terms of saying, if the GAR were to create issues for the wider captive opportunities, then that would be a concern. What I mean by that is clearly, and there's already been commentary that's been made historically about, UK employers' liability, UK motor liability, for example, on a direct basis. Okay, fine. Yes, absolutely. That falls within the GAR and should continue to be. But there are other elements, for example, on a reinsurance basis, behind a fronting insurer, where the consumer, should we call it, responsibilities, requirements are administered by an onshore insurer that's sort of fully compliant with either UK regulation or Gibraltar regulation via the GAR, then that should be sufficient. And therefore, we would like to see the opportunity to be able to include liability risk on a reinsurance basis. And that, I think, really sort of will lead to providing a competitive position for Gibraltar within the wider context. I mean, there was reference earlier to making sure that Gibraltar really competes on a global platform rather than just a European platform. We've mentioned other domiciles. Those other domiciles have capabilities to write not admitted across a number of different classes of business. And I think if we are going to position this, and Gibraltar really has the opportunity here to, it's probably a once in a decade or once in a generation opportunity to create something for the future, to differentiate itself, to position itself, to take new captives, either on a pure captive basis or on a protected cell basis for the future. This is now the time that we want to get it right. We want to make sure that we have the scope correct, that manages all of these risks, but also permits, Gibraltar to compete.
I want to ask you a follow-up from that, Adrien. It's very similar to the question I asked Liz earlier on our fireside chat regarding the developments in the UK. Mm-hmm. So tying that into the GAR and your opinion, your view on, where's it going to land in terms of the different liability lines and how they're treated, if they're treated as third-party risk or first-party risk. As I mentioned earlier, that debate's been happening within the UK regulator. We're trying to say to them, to ease off and be a little bit less conservative. Do you think it is important, as this dual captive regime emerges here, that Gibraltar keeps an eye on what is happening in the UK, and that might help them or hinder them, or depending on where that lands? Will it be relevant at all?
Well, I think Gibraltar really needs to future-proof itself against what's happening in the UK as well. Okay, the UK is a sort of bigger entity. Gibraltar has the opportunity to be more nimble, to actually understand what captives are about, and to put the framework for captives moving forwards as something which is fit for purpose. I think having those conversations with the PRA, for example, will take longer. All right, so we have the opportunity here to be nimble, put something in place that, frankly, the UK, I think we're hearing they might have some concerns in some of those areas, but frankly, if they were properly educated around it, with a front in place, there really aren't those concerns to have.
Yeah.
So we just need to make sure that Gibraltar takes the ball by the horns.
And similarly, make sure Gibraltar knows that, and the regulators here know
Absolutely.
that. The same reasons. So, in terms of, and Michael would start to touch on them, he talked about capitalisation and operating costs, but if we do get a great regime here in Gibraltar, a great dual captive regime, and it's kind of in line with all of your wishes, what are the important areas that Gibraltar needs to be competitive on then to attract new business? It's one thing having great legislation, it's another thing having the regulatory resource and the understanding and all the IP. I mean, I think it's not in doubt that all the right insurance infrastructure is here and available in terms of the banking, the accounting, and the consulting, and the captive managers. All that stuff is here. But what areas does Gibraltar need to be competitive on to actually, when they get to the final 3 or 4 domicile choices of a client who's looking at Bermuda, Guernsey, Vermont, and Gibraltar, for example, where does Gibraltar need to be competing?
Well, I think there are 3 core areas, right? There's strategic, financial, and operational. So from an operational perspective, we need to make sure that there is access to service providers that mentioned, right? We need to make sure that from an operational perspective, the requirements aren't too onerous, that they allow the administration to be efficient but efficient from a cost perspective as well. An example, for example, a requirement for an actuary. Is there really a need to have an actuary for a captive? Should that depend on the complexity of the captive? Certainly a simple captive, really what's the purpose, what's the value that's provided there? If we sort of move towards the financial side, we need to have a look at the operation costs. We have a look at the capital and solvency requirements. Much of that, I think, is being considered within this process as well. So we just need to make sure that's proportionate. And then I think key is the strategic area. We need to make sure that there is underwriting flexibility, and this comes back to making sure that we have the scope within the framework to be competitive, to have the flexibility, because frankly, companies may come with a specific issue, and okay, day one, that specific issue might be a property issue, and it might fit into what's available today. But the reality is most of them are looking to the future as well. How are we going to build and grow this captive? And if we're restricted, that will create complications in terms of selecting Gibraltar moving forwards, despite the initial need and purpose.
Anything to add to that, Michael?
No, I think, again, what was really explained to me was, some of the, maybe the oversight as well. So I think there was certainly at early stages, there was talks about, who would provide that oversight in terms of like an INED. Would you need that on a captive, or could you have the chief risk officer or the chief financial officer coming down and providing some of that oversight at the local level at the captive insurance here? So I don't know what's finally going to be announced, but I think those were the sort of questions we're having in saying, how do we be pragmatic and still maintaining so we're not looking to bottom feed, but still maintain high standards, but in a way that we're allowing these businesses to operate at a cost level which allows them to be attractive to potential new captive owners.
That last point regarding the governance, and I'm going to come to you on this question regarding the non-executive directors, Kathryn, because you're the right person to ask it to. But it's interesting you mentioned that, because in the conversations in the UK, obviously London Market Group are putting forward what they want to see, and they're obviously super ambitious and they want to bring down the operating costs and do all the things we want to do. But we had the question in the UK from the regulator being like, we don't want to be a race to the bottom. And it's like, well, of course we're not. We're not proposing that. And one of the things that AIRMIC put into our kind of asks of the UK, if they do proceed, is actually there's only 2 domiciles in the world, as far as I know, 2 captive domiciles in the world currently, but actually it is a statutory requirement that you have an independent non-executive director on the board. It's Guernsey and the Isle of Man. Switzerland do require it, but you can get an exemption. Otherwise, no one requires it. You might require a resident director, but that could be the captive manager or someone else. It doesn't have to be independent. So we've asked for that. Kathryn, what's your view? Obviously, I imagine you probably want more opportunities for more posts, possibly.
That would be amazing. Yeah.
But in terms of, do you think that kind of thing regulators should be asking for that? What's your view on whether INEDs for captives specifically should be required or should be compulsory?
Wow, that's a fairly wide-ranging question.
Yes, sorry,
Thank you.
I've chucked it on you with not much notice.
That's a good one. And I think you kind of have to step back and look at what are the risks in the company. So I think a key role for a non-executive director is holding people to account. You are one step away from the day-to-day running, so you can ask the hard questions. You can get more or less involved in the detail as appropriate. So I think it's not an overhead that you have non-executive directors. It's a value-adding thing.
Yeah.
But I have a friend who is very senior in the banking industry, and she says everybody is accountable to somebody. And personally, I think that's the way it should be. You then have to say you want good non-executive directors, the ones who are going to ask those questions. And I think perhaps even more importantly than asking the questions, you need to follow through on the answers. So if somebody says, oh yes, that's fine, don't worry about it, that's not good enough. You have to say, well, I am worried about it and I need to see the evidence of why I shouldn't be. So I think it's kind of like you need to be proportionate, but I think a well-run company would probably want somebody in that position.
Yeah.
Whether the regulator should impose it is a different question, but I think it would be just a good thing to have anyway. I don't know. What do you guys think?
Do you see it, Adrien, do you see it as the argument against it, and we hear this a lot from the US or from other people, is it's an additional imposed cost. But I agree with you, Kathryn, it shouldn't be seen as an imposed cost, it should be seen as a value add, but is that the argument against it?
I think Look, I'd be reluctant to impose it. I think there's a lot of value created, as sort of indicated from Ned's, INED's. I think certainly it should be a recommendation, and certainly as the captive increases in complexity, then maybe it starts to become more of a requirement. But what I wouldn't want to do is impose it for the smaller captives, because that level of additional cost could be disproportionate and could actually sway the value or the decision-making process in creating the captive.
So let's move on to PCCs, protected cell companies, and cell captives, and Graeme and Kathryn are both very experienced in this area, and we'll start with you, Graeme. I mean, cells, again, over the last 4 or 5 years, with the kind of explosion in captive business, cells have been a massive part of that. We have seen a lot of new cells set up in jurisdictions all around the world, new protected cell companies and new cells within those cell companies. And Europe actually is fairly lacking compared to other parts of the world, particularly the US. Europe is fairly lacking in cell options. You've got Malta's the only EU onshore, within the EU option. You've got Guernsey. Isle of Man has never really embraced it, although they obviously have cell captives, and they've got Gibraltar, of course. What kind of cell business do you see within Euroguard? What kind of stuff are you doing cell business in Gibraltar?
Yeah, so I mean, I think, as you say, it's really been undersold or underwhelming in Europe over the past few years. The type of business that we're seeing currently coming to us, prospective clients coming to us, is still very much focused on first party business. So, as opposed to putting together a standalone captive or a wholly owned captive, clients looking to use a protected cell as an alternative solution. So those are by far the bulk of the inquiries that we get. But what we are seeing more of, what I'm certainly seeing more of in terms of inquiries that are coming to us, is clients that are using or looking to use a protected cell for third-party business. Now, I mean, we know that the FSC put out their view a number of years ago to say that they are willing to look at third-party business being written through cell captives, and I think there is an appetite out there for clients that want to use it. I mean, the ones that have come across my desk over the past few years, certainly your MGA type environment where you've got an established MGA who's been writing specific lines of business for a long time. They understand their book, they understand the profile, loss ratios, etc., and they're looking to actually participate in the risk, wanting to set up a cell so that they can be the frontline underwriter of that business into the UK. Obviously partner with reinsurers, either their current capacity providers to sort of flip the structure and act as a reinsurer, but then with them taking a stake in the business. And it's been mentioned a couple of times today already in various panels that the flexibility that it gives them in terms of being agile, rather than with their current carriers or capacity providers, if they want to change something, if they want to amend something in the wording, relook at pricing, it needs to go into that huge machine and takes time for the carrier to come back. Whereas if they've got their own cell, they can, through their own internal governance structures of the license and themselves, get those decisions made a lot more quickly. So there certainly is appetite out there. Also I'd be out of a job very quickly. I'm a great supporter of Gibraltar. For all the reasons that everybody has mentioned throughout the day. I think it's the reputation of Gibraltar in general is very good because of the fact that it is so well aligned with the UK from a regulatory perspective, and I think there's a lot of opportunity and a lot of hope for the future, certainly from a cell captive perspective.
Thanks, Graeme. And Kathryn, from your perspective, what's your experience been with cell captives, and what kind of cell captive business do you see here, or cell company business do you see here?
So I'm working with a company, not Marshmallow, a different company. They're an American company who already have a protector cell business based in Oklahoma, and they're looking to set up a protector cell business here to write business into the UK. So they're looking at third-party business and reinsurance. And the reason they want to use the PCC structure, because that's actually quite a big question, is because they want to segregate each line of business into a different cell so that they can give the underwriters some ownership, as you were saying, Graeme. So it puts the underwriters in, which are either MGAs or underwriters within the company I'm working with, the opportunity to be part of something bigger, so you can access reinsurance markets more efficiently, you get the economies of scale in the administration and the governance and so on, but you've got your own balance sheet and profit and loss account within the cell. And although I've spoken to my client about actually this is less capital efficient, they're adamant that this is the right way to go.
So you've obviously been having those conversations on the kind of the pros and cons of a cell company approach in that particular use case. But for you, Kathryn, first, and I think Graeme, I think it'd be good to you to chime in as well. But do you think there are still common misconceptions or misunderstandings of what cells are, how cells work out there?
I think so. I think maybe you mentioned use cases. Maybe it's just not been tested enough. It's you need to kind of have a go with it, see it works properly, and then carry on. So I say the company I'm working with already do this in the States. So they've got tons of experience, which we want to bring to Gibraltar. And I think from an actuarial point of view, the point I've made to them is if you put all this in one insurance company, you'd actually need to hold less capital. You're going to have to capitalize each cell independently. So when you add it all up, the PCC will have more capital because you can't diversify the different lines of business. You must have found that.
Oh yeah, absolutely. But when you talk about misconceptions as well, from a filtering perspective, when I get people approaching me to speak about potentially opening cells, there is still quite a big misconception out there that it's an easy way to write insurance business, and I can give you £10 of capital, give me a cell, and I'm going to write insurance business. So that's certainly from the perspective of our business, a very important part of the approach that we take to looking at prospective new clients is that filtering process, where there has to be a proper understanding between ourselves and the prospective client of exactly what they're getting themselves into and what we expect from them in terms of potentially running a cell cap. We expect them to behave in a manner as though they were running their own insurance company. For all intents and purposes, that's what it is, essentially. The fly-by-nights who think they can use it to make a quick buck, they are still out there, believe it or not. And those are the types of misconceptions that I find myself dealing with more often than not.
Yeah, and of course, I think PCC is probably, I think, people have increasingly understood them more, and we won't go into it in detail, but obviously the Vestu case in Bermuda and Aon's PCC there, I think there's a lot to be unwound in what's happened there, but things like that don't help sometimes, and that's not to put any blame on anyone apart from Vestu, but, things like that don't help. And I think cells, we're still kind of going through. I know the minister here, Nigel, obviously is a great legal mind on this topic. He used to write articles for me all the time at Captain Review on kind of the legal uncertainty and stuff of cell companies. And I asked Adrien earlier regarding kind of his wish list or what he would love to see from the dual captive regime on the regulation of cell companies here in Gibraltar. What are some of those regulatory challenges that maybe you do still face or have to kind of overcome regarding running cell companies, cell captives here?
I mean, from a very broad perspective, I don't think the regulatory challenges that we face are any different to any other insurer, any other captive. We understand the framework. We understand that we have to work within it. Like it or not, Solvency II was definitely not a one-size-fits-all.
Yeah.
Kathryn said, what was the term you used yesterday?
I was saying if you have to buy shoes for an entire army, but you're only allowed to buy one size of shoe, you buy the biggest size of shoe. They can get their feet in, but that means that only a small percentage of the soldiers can actually walk.
Yes, it's not a one-size-fits-all. And you know, as with everybody else, we find ourselves making sure that we work within the requirements and what is necessary. But, you know, in terms of a wish list, I would hope that the dual captive regime, when it does come in, will cater for PCCs as well. So that you're able to have a, probably, of course, in a separate license, where you're able to establish sales under the dual captive regime for all non-UK business. And it would be, I think it would be a game changer for us, because, you know, certainly I've had conversations, and I'm sure you can hear from the accent, I'm originally from South Africa. There are conversations that I've had with potential large clients for captives who are immediately put off by the Solvency II capital requirement. And in terms of the dual captive regime being more fit for purpose for that type of business, which is very specific, all first party, well controlled, well managed, it would fit perfectly into our business as well. So, you know, I really hope to see that we get a benefit from that too.
Yeah, that would be really interesting if they were able to make sure that a cell could take advantage of that dual regime. How about you, Kathryn? What are the regulatory challenges or obstacles or things that we could do better?
I think what Graeme said, it's exactly the same challenges as setting up a non-PCC insurance company. But one thing I'd add, we've talked a lot today about ease of access to the regulator, flexibility of the regulator, speed, and so on. And I think one thing we've kind of touched on in this panel is that Gibraltar is a speedier jurisdiction than the UK in terms of developing and changing legislation. So I think my ask would be, let's get it in, see how it works, but let's be ready in a year, 18 months' time to change it if it needs changing. I think that would be my ask.
Adrien, obviously you consult on captives all around the region, and I imagine sell captives as well, and you've got clients that have set up cells. Any views on the kind of this topic regarding cells in Gibraltar specifically?
Well, I think it comes back to the fact that Gibraltar has some excellent competition out there. And if we look at that excellent competition, they allow sales within their captive frameworks, and really I see no reason why they shouldn't also be included in Gibraltar. I mean, it seems the sensible thing to do in order to optimise the opportunity and to maximise what Gibraltar is seeking to achieve by bringing in this new legislation.
I think something I hear a lot about all these different conversations in different domiciles who are either introducing captive legislation for the first time, or in the case of Gibraltar, updating captive legislation for the first time in a while, was the point you made, Adrien. But this could be a once in a decade, opportunity. So I think you're probably right, Graeme, as well, that if there are changes being made, let's get everything in there now, because it doesn't necessarily mean you're going to get a second go at it in a year's time or 2 years' time. You might be waiting another 10 years plus to kind of review it again, because parliaments are busy, and surprisingly captives aren't always the biggest priority, right, on people's agendas. We've pretty much got through most of what I wanted to touch upon on this session, but obviously we do have plenty of time. If we've got any questions from the floor, we'll have a microphone come round to you. Anyone? Oh, there is a hand up. Yeah, I'll just wait.
Hi, Chris Johnson, who Michael mentioned at the beginning of the session that I've been here for something like 40 years. It probably feels more like about 60 for people. There we are. So back in '96, when Nigel Feetham and I worked on setting up Euroguard, it was, of course, in those days a contractual cell captive, which was very interesting, talking to our then regulator, who wasn't even an insurance guy and certainly knew nothing about cell captives. But one of the benefits of the PCC legislation, which, again, Nigel had a hand in drafting and was passed in 2001, was, and we talked a lot at the time about captive cells, and one of the benefits was that if you set up a captive cell, and this certainly was a feature of the Guernsey legislation, you could use it as an incubator, and then there was the facility within the legislation to spin that cell off into then a standalone captive. And it was seen as, it was one of the things we marketed. I don't think, I was then involved in Aon and White Rock. I don't think we ever did anything like that in any of the PCCs that I was involved in. So I just wanted to ask Graeme whether it was something that that you guys have done without giving away any secrets, or indeed if it's maybe in the business plan for the future if the PCCs come into the dual captive regime.
So yeah, I mean certainly it is something that is always communicated by myself to existing and prospective clients, that they have the opportunity to use the cell structure as an incubator, build up capacity over time, and when they get to the point that they feel it's too big for a cell and they'd like to have more control, they can do that. And we actually had one client that went through that process. They incepted a cell with Euroguard. It wrote business for some time, and then got to the point where the owners of the cell decided that they wanted to have their own license, their own control over the runnings of that insurance part of their business, set up their own PCC, and the business was transferred out. Luckily enough, we were able to continue our journey with them as a client by setting up an insurance manager to assist them to run the license as well. So yes, that's actually a very good point, and one of the largest selling points of the cell proposition. And I think one of the gentlemen mentioned it earlier, you almost end up working yourself out of a job, because you take them on, you put it in there, you help them to grow it, and then you see them move on to bigger and better things.
Yeah, and if I can just add to that as well, I think often when we speak to companies, we need to remember that from a captive perspective, insurance is not their core business. Okay, so often coming in on this journey, as we sometimes call it, I hate it, but never mind. As they come onto this journey, they really want a stepping stone. They want to understand what this will do, how it will work, before they go two-footed into managing all the governance and everything else, and having the board responsibilities and all of that goes with it. So the cell is a fantastic way of starting that process, really dipping your toes in, getting an understanding before going full on into a full pure captive. So yes, it happens. It's an important part of that sort of transition for an organisation in their risk financing journey.
I think I've heard of, maybe particularly in the last couple of years with the state of the commercial insurance market, more instances of it happening recently, because I think in other jurisdictions there's definitely been quite a common instance of, someone gets their renewal date, they get very close to their renewal date, particularly on things like professional indemnity, cyber to a degree, and they're screwed, for want of a better term, and they need something else. And so the only way to do something quickly in terms of self-insuring is a cell. It might be that they know, actually, we do want to turn this into a standalone captive we have full control over, but we only have time to do a cell now. And I know a few examples out of the UK market where it's all happened in a space of a year. They set up the cell super quick to solve a problem yesterday, and then 6 months down the line, they do the more work to set up the standalone pure single parent captive and transfer that business in. I know that in some jurisdictions they advertise it's very easy to turn a cell into a pure captive. From what I've heard, it actually often isn't that easy, and they end up just setting up a brand new vehicle, and it's actually easier just to transfer the assets and liabilities over, even though it's meant to be much simpler to do it, where you just convert the cell into a pure captive. But I don't actually see that happening very often, but it's essentially the same thing.
The conversion rarely, but certainly the moving from a cell to a pure captive, usually with the setup, is more common.
Yeah, and I think there was another interesting case I saw in Vermont. I think they set up end of 22, and that was a group purchasing organisation in the States. You know, lots they own, or they're it's kind of a group purchasing organisation of lots of quite well-known high street brands or grocery stores. You might say kind of regional organisations, but they come together to share certain services, and their kind of holding company set up a cell company recently, when some of those retailers are actually pretty big, you know, $100 million or $1 billion companies, but they're getting involved in captives for the first time. They have a cell, but purely with the ultimate expectation that they probably will take that out and spin it off as their own single parent captive in the long run. But in the short term, they're taking advantage of that group purchasing kind of structure they already have in place to share a captive facility in the form of a PCC. So I think there's lots of use cases that we are seeing that materialise. Any other questions from the audience? Otherwise, I think we eat for coffee next, don't we?
We do indeed have another coffee break coming up. I'd highly recommend people step out and have 5 minutes outside, because it is glorious. And we'll see you in about 30 minutes. Thank you so much. Big applause for the panel.
Thank you.
Okay.